Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is William Mahan, who I'm going to call Bill. And Bill is an attorney in San Jose, California. He is of counsel to Gates, Eisenhart, Dawson. He's been practicing law for about 35 years, has a master's in taxation from Golden Gate University, and a JD from Santa Clara University. Bill's practice focuses on estate planning, probate, and business planning. So Bill, thank you for joining me today.
My pleasure.
Okay. Today, Bill and I are going to be talking about tax and financial considerations of title. And related to this, first of all, we're going to say we want you to seek legal counsel, and also to be aware that we're talking about California law. So for example, we're going to be talking about community property, and community property operates a little different from state to state and so forth. And of course, some states don't even have community property. So definitely you're going to need to get legal advice about how title works in your own state if you're not a resident of California. Okay, Bill, off we go. So what are some different ways that you can hold title to property?
Well, individuals can hold title as their separate property.
Mm-hmm.
It should be their separate property if they hold title that way, but that's one version. They can hold title as tenants in common, and that means that's a unity type of ownership where you have multiple people who are owners, and you could even have some of the parties who are tenants in common and some who are something else. But the point is that the property owned as tenants in common means there's a unity of ownership, so each owner has a right to use and benefit from the property just as much as any other owner, regardless of their percentage of ownership. There's something called joint tenancy with a right of survivorship. That's also obviously joint ownership, but with right of survivorship means that if you're the survivor, if your co-owner dies, that you're the person who gets to own the property. And again, you could have multiple people and they just one at a time drop off from that. There's also something called community property, and community property with right of survivorship. This has to do with what you were talking about with in certain states. Actually, I think there's only 13 states that have community property, so most don't. But California does, which is where we are. So in order to own property as community property, you have to have some marital type status. So obviously marriage is one of those statuses. The other is a registered domestic partner, which is a same-sex couple that hasn't gotten married but has registered with the state of California as domestic partners.
And even two-sex couples can be registered domestic. So.
Yeah, heterosexual couples can be if at least one of the members is 62 years or older.
Yeah, that's
so people often overlook that, but it is possible. But that's the status that people can attain in California that allows them to have community property, and then they could title property that way. And then other things would be some kind of ownership in trust, like a Totten trust. That's a kind of payable on death type of an account that you would open somewhere where you name, it's your account, but you name somebody as the beneficiary when you die. And other types of accounts that have some kind of beneficiary designation attached to them so that you can specify in the titling of the account who the next owner is going to be. Then there's also titling in entities, and that's where you transfer title of property to an entity that you own. It could be a trust or a LLC, a limited liability company, or a partnership, or even a corporation. So the entity holds title to the property, but you own the entity, or you and others own the entity. Yeah. Those are pretty typically how people do it.
Okay, so that's a pretty good menu of choices there. So is there any particular significance? There's been these Supreme Court decisions recently about gay marriage, basically, and now I guess we can say gay marriage is now the law of the land.
So obviously this affects the status of things like community property. But you need to be, this is one area where you need to be really careful about state law. So we're talking from California, but we need to be careful because people move around.
Right.
And even though the most recent Supreme Court decision says that people have the right to get married even if they're same-sex couples, and so now it's the law of the land, it's still going to be a little bit different from state to state how it's going to work, because state laws are still going to have an effect on what that means. So in California, we have community property law, and it's actually, it's occurred to me that it's possible for same-sex couples to, or basically have more ways of having community property than heterosexual couples, because unless, again, it's somebody 62 or over, if you register as a domestic partner and you haven't gotten married, you can have community property. If you're married as a same-sex couple, you can have community property. So you have two ways of doing it. As a heterosexual couple, you are married, or you fit that very narrow definition for the domestic partner situation. But again, this is where it matters, because federal law says that marriage is marriage. So whether you're same-sex or heterosexual couple, if you marry anywhere now in the United States, because it's legal everywhere, then for federal purposes you are a married person, and the federal rules that apply to you are those of a married couple. However, the federal law doesn't recognize registered domestic partners the same way that it recognizes married couples for purposes of, exclusions and exemptions and all the things that apply to marital couples.
Right.
So you just really need to be very careful. It's become, I think, even a little bit more complicated for people to sort out how they want to do things, and decide whether they want to be married or not. That's the very first step they need to get to work.
That
through.
decision to be married, and I've heard about, I guess you read the paper too, so that the county clerks in some places are refusing to issue licenses, even though they're saying that they have a religious conviction, and so they're refusing to issue.
Yeah, so it's going to vary a lot from place to place. But even beyond that, the minutia of the rules that apply in different places are going to be quite different.
Yeah, and the registered domestic partner issue that you're talking about. So, I mean, I think one thing, now that we've got these decisions, I would say that, if I was dealing with somebody, with a client who was the registered domestic partner, I would be inclined to say, maybe you should think about whether you should get married. Because it being a registered domestic partner, like you said, it creates a dichotomy.
Right. Well, that's been true in California for a while, though, because California's allowed marriage for
the RDPs for longer than the marriage.
Right.
And then California was one of the earlier states to actually adopt the marriage, and then of course then we had our own litigation.
Right.
And
but I think it's an important consideration for couples. We've talked a bit about younger people not getting married as they used to, and so it's always a big decision, because it's going to have a big effect on all of these issues we're talking about, how you own property and what happens when a person dies and all of that.
Right. So what are some ways that people try to bypass probate by the type of title that they take?
Well, it's a pretty long time common practice for people to do things that they've heard about, and they do work. And there are certain types of assets that are almost always held in a way that bypass probate, because things like life insurance, everybody knows life insurance, you have a beneficiary that you designate, or beneficiaries. And because the insurance company is going to pay the insurance to the beneficiaries you designated, they don't need a probate court to tell them what to do. So things like insurance bypass probate, that's normal. Annuities are another thing that would do that. Retirement accounts, you would typically have a beneficiary designation that would avoid probate. But for real estate and bank accounts and stock accounts and things like that, what people will sometimes try to do is have a way of holding title that allows it to pass to a survivor, like joint tenancy, or community property with right of survivorship, and then it passes to that person, and it doesn't go through probate to get there, because there's no need for that to happen. That's fine. It's referred to often as the poor man's estate plan. And the reason it's a poor estate plan, though, isn't necessarily because of the financial wherewithal of the people involved. It's because it doesn't always work well. It's not really planning, in my opinion, because you're hoping that people actually die in the right order, and that if parents add their children as joint tenants with right of survivorship, the parents will die, and then the children will inherit the property, and it won't go through probate. But if something happens to the child before the parents are both gone, now it's the surviving joint tenant is the parent. The property didn't go anywhere, and it's at the parent's death going to go through probate to somebody. So estate planning, in my opinion, is a better way to resolve that kind of an issue, because it works even if people don't die in the right order. You have a plan that sets it out.
Yeah.
So.
You can just have a situation that you could have a mutual accident. I mean, both die at the same time.
Simultaneous death, it's called.
And so if both die at the same time, then suddenly this joint tenancy thing isn't going to, solve it. If you have the joint tenancy arrangement with no will, now we're back to intestacy and
right.
in that process.
Right, and you're back in probate court.
Okay. What are some concerns about holding property as joint tenants with children? So I see this happen quite a bit.
Right. Again, people think they're doing estate planning when they do that. And they are in a sense. I mean, if everything works out, and oftentimes it does, then the children will outlive the parents and they'll get the property. But anytime you add people to title to your property, it doesn't matter how you say it. If you put their name on the title to your property, then all of the things that are going on in their life suddenly affect that property. So if your child is married and they go through a divorce or a bankruptcy or something like that, and their name is on title to your house is now part of that marital estate or bankruptcy estate, and you might be able to explain your way out of it, but it's not necessarily a good thing to have that happen. If there's a major liability issue and the child's insurance isn't adequate to cover the liability, again, your house is an asset that's their name is on, and so there's a potential liability to their creditors. And then there can just be disputes that arise within the family. And so when you added the children to the title, everything was great, but then something happened and you're not in agreement about things anymore, and now people don't agree necessarily to get back off of title to the bank account or the house, and you have a problem, you have a dispute.
So it may be something that's a lot easier to set up than to get out of.
It's very easy to do, and sometimes very hard to get out of.
So
the other way people get on title oftentimes is that parents will co-sign for their children to buy property, and that's sort of the reverse problem. But it can actually end up having the same kinds of issues. But you also have problems unwinding that arrangement, because when you take the parents off of title, if they weren't actually intending to own a percentage of the property, then you have to explain, well, why did it say they were owners, and it looks like they're equal owners and now they're not. Did they give you half the property? And it creates legal issues that you have to kind of wrap your head around to try to solve.
Yeah. So on some of these, you could actually unintentionally make a gift that should be reported.
Yeah, everything, in law, everything, they say it's substance matters more than form. But in things like deeds, the form of the deed pretty much tells you what the situation is. And so if you do another form that seems simple to solve the problem, then it looks like something else altogether, and it could look like a gift or a sale or anything like that.
How can a husband or wife accidentally transmute separate property to community property, and what are some of the consequences?
Okay, well, let's talk a minute about how husbands and wives have separate property.
Okay.
So before you're married, if you own property as a single person, it's your separate property. When you get married with that property in your possession or ownership, it doesn't automatically become community property. It remains separate. And so things can happen that will transmute it. That's the word that's used, transmutation, to transmute it to community property. It can be done intentionally, where a spouse signs a document saying, I want this to be community property. But the way it happens unintentionally depends on what the asset is. So if it's a a bank account and you have $100,000 in your separate account when you get married, and the week after you're married, you deposit your now community property paycheck into your $100,000 separate property account, that's called tainting, and you've made a community property asset of that account. So it can be very easy to do with certain types of assets. With things like real estate, it's more gradual because it doesn't taint immediately, but over time, if you make the mortgage payment, pay for the insurance, fix the property, repair the roof with your paycheck, then you're creating a community interest over time in that asset. So the other thing that couples can do, as I said, is they can agree as to the status of their property. So even during the course of the marriage, if you want to re-separate things, you can sit down and write an agreement. You usually have to have a couple of lawyers involved again to do that, but you can agree differently. The other thing that can happen is after you're married, even if it's all community property that you own as a husband and wife, if you inherit property from your parents or grandparents or someone else, brother, sister, when you inherit it, or if you receive it by gift, it's still considered separate property until you do something with it that makes it community property.
Okay. What is a tax basis concern for community property as opposed to joint tenancy property? And how are these two types of title worded differently?
Well, the problem that arose, there's something that happens when a person dies. And this has been part of the federal law for a long time. Kind of wavered a little bit at one point, but the basic rule is that when you buy a piece of property, whether it's a stock or real estate, it has something called basis. And that's the number that usually it's the purchase price, it's the number you use later to calculate whether you had a gain or a loss on that asset.
So it's like the cost that you use for tax purposes when you're on Schedule D when you're selling the asset.
Yeah, typically. So basis matters to people, and one of the things that's kind of unique about the estate rules is that if a person dies, their assets that have basis get a new basis. It's fair market value as of the date of death. So a very low basis asset can go right up to the fair market value if a person dies, and then if it's sold the next day, there's no capital gains to pay. So the problem arose because people who were married, again in California, there's this community property issues. They would own property very typically and commonly as joint tenants with right of survivorship, even though they were married people. And then at the first death, a very simple form would be recorded called affidavit death of joint tenant. But the IRS ruled that, well, if you do that, then only the decedent's half of the community gets stepped up to the fair market value, but the surviving spouses stays down at the purchase price. And so you had the situation where there was two different bases now in the property, and if you sold it, there was a gain on the survivor's portion.
Right.
And so community property isn't treated that way. Community property has sort of a unique aspect where if the spouse dies, both halves get stepped up to fair market value at date of death, and so you get that benefit. So the way this was handled by attorneys who were aware of the problem was they wouldn't terminate a joint tenancy with that affidavit. They would treat it as community property. They would record it a community property affidavit, and they would get the stepped-up basis even though it was titled as joint tenants. Now we have this community property with right of survivorship that's a way of holding title. And I think that was done in recognition of that problem, so that people holding title that way would get a full stepped-up basis.
Yeah. So part of what was going on is basically that, let's just say it was standard operating procedure at the title companies that when they were putting together the documents and people were buying homes, and people don't typically don't visit with their lawyer, and a lot of lawyers didn't even know about it at the time anyway, this problem. So they would just go ahead and prepare the title documents as joint tenants automatically, and so the people will say, okay, well, I just signed here to buy my house.
Right. When I was first practicing law, that were almost all property was owned that way, husbands and wives. I mean, I'd say 99% would be titled husband and wife, joint tenants with right of survivorship. And why? There's probably different reasons why. Maybe it's just because everybody thought that's how it should be. but I believe it also has something to do with the title companies feeling more comfortable with that title.
I think that they did, yeah.
Yeah.
Okay. What are some title considerations for entities like trusts and family partnerships?
Well, I'm not quite sure what you're asking. Title considerations.
Well, what if you have an item that you want to be in that trust?
Oh, okay. Yeah, well, people, I think what you're getting at is people often set up entities.
Mm-hmm.
And once they set up the entity or they have someone set it up for them, they think, okay, I've done that, now it's fine. But I've seen partnerships and trusts and things like that years after they were set up, and you say, okay, so what are your assets? And you start checking the title, and nothing's been titled in the name of the entity. And that creates some real issues. And why that's done, sometimes it's done intentionally because people think it's simpler. Sometimes it's done just because setting up the entity was the main idea for whoever was doing it, and the titling is something that you should worry about, and it doesn't get done. And so now if you're trying to avoid probate, you haven't put your assets into the trust, so you haven't avoided probate. If you're trying to have limited liability protection from an LLC or a partner or a corporation, you haven't gotten it because you still hold title to the property that you were supposed to transfer. Another thing people will sometimes do, and I've heard about this again recently, is what they call pocket deeds.
Uh-huh.
And that's a deed where you sign the deed transferring it to the trust or the entity, but you never record it. Mm-hmm. And again, you do this because you're told that it's an easier way to do it, and you can get refinancing much easier, and you don't need to really worry about it. But it can create real problems because pocket deeds, when title companies see them years later, especially if the person has died that signed the deed, they don't want to process them and record them. So you have probably a court proceeding ahead of you. So yeah, it's important to get these things. If you're going to use something like an entity or a trust, you should fund it with the assets, which means titling the assets.
So you need to go through those formalities. Yeah. I'm not quite sure where we are on our time schedule here. Okay, we've got about 5 minutes. What are some California property tax considerations? And again, I know this is really probably, I have a whole program about this, but I'd just like you to bring out a highlight.
Yeah, well, when you title assets, typically what we're talking about, a real estate situation is going to require some kind of a deed, some kind of a document that's going to be recorded. And so two things happen when you record a document in California that affects the title to property. One is because we have something called Proposition 13 in California, which has been modified a bit over the years, but it basically says if there's no change in ownership in the property, then there's no reassessment or higher assessment of the value of the property. So we have properties in California that have been passed from parents to children, things like that, and they still have a basis of, as if the property was worth $30,000 when it's worth $1.5 million. Mm-hmm. So the assessor and the county tax collector, they're interested in being able to fix that if they can and get more revenue for that valuable property. So they're always looking for a change of ownership when a property transfers. And so if there are certain exemptions from that, and you have to identify those when you record a document, you have something called a PCOR, a preliminary change of ownership report, that you have to also file with the county telling them what happened. And then that will determine whether they get to reassess the property or not for property tax purposes. The other tax that is incurred when you record things is called a documentary transfer tax. And if there are certain kinds of transfers that are also exempt from that, and so if it's like a transfer to your trust, your revocable trust, they can't reassess it for property tax purposes, and there's no transfer tax. But you have to explain all that, and you have to set out the actual exemptions as part of the recording, or you will get inquiry from the county.
Yeah, you get a friendly letter. So this could be part of the reason. Again, you were mentioning the pocket deeds and so forth. People try to find ways. They think that they're being clever by not reporting these, but actually what they can do is they can actually have penalties and other things that can apply, and in some cases may not get the exemptions that they may actually be entitled to.
They may not be able to record the deed if they need to, which is sort of a myth that it doesn't matter, but it does matter because there are title companies that have a problem with it. And also, if it was a limited liability entity, you might find yourself personally liable for something that you should have been able to avoid.
Yeah, and the IRS also has said that they want to see that title
Right.
change, and so they may not even honor your transaction
Right.
if you haven't recorded it.
Right. If you think you're going to get a deduction for part of the interest or something, if your name isn't on title, you're not going to get that deduction.
Right. So, or if you do, it'll be very expensive to do it because there is litigation that's happened. In some cases, people have gotten the tax court to accept it, but it's a very expensive process to get there. So why not save the money and just
Right.
do it right in the first place?
And it's uncertain, so it's not really good practice.
Okay. Well, we have about 2 minutes. But do you have a final thought you want to throw out, or?
Well, I would just like to say that conveyancing is a very complicated matter. It doesn't seem like it sometimes. People will record documents that they just handwrite and take to the recorder's office, and if it looks right, technically it will get recorded. But if you just use the wrong word or the wrong combination of words that don't really fit together correctly. I recently have a case involving a person who took title to property as a married person, and it was their separate property, but they didn't add the phrase as her sole and separate property.
Oh.
And subsequently, the marriage came apart, and she had a really difficult time conveying the property because it just said the one, and that creates a cloud on title.
Right.
So you have to be really careful about the wording of these things and make sure that they are accurate and understand that there are consequences if it's not correct.
Okay. Bill, we're all out of time. Thank you again for joining me today. It's been a pleasure having you as my guest. Folks, hopefully giving you some things to think about and reasons for you to think about actually taking advantage of getting legal help. We'll see you next time on Financial Insider Weekly.